How you guys doing? Lesson 48. It is now 10 seconds after our last episode ended. That's nice. I'm not used to having shorter lessons. You gotta probably work on that. Lesson 48. How do we finalize our rules? I have 10 points I want to bring to your attention. This does coexist with our consistency talk. How can we bring these 10 questions I'm about to ask you to finalize your own sets of rules? The whole entire point of this course, as I pet my kitty, the whole entire point of this course was for you to kind of make your own edge, make your own rules, make your own structure, and then you can fish by yourself. I'm going to ask you 10 reflective questions. I'm going to dig in each one of them, explain why I'm talking about them, so that when you kind of finalize your rules and your edge and you kind of enter the trading force, the trading people, 30% of the market now is retail traders. As you enter them, how can you be better than them, stronger than them, faster than them, all those kind of great Daft Punk lyrics over them. Great joke. With that being said, lesson 48, 10 things to help you finalize your rules. Let's get into it. So first is, what is your risk management strategy, and how and why do you find your maximum risk per trade? This is huge, and I think it's a really easy one to talk about, but reflect on that before you finalize your rules in your own head or on paper, whatever it is. As you finalize your trading strategy and your structure, it's important to note how you figure out what your risk management is going to be and how much you're going to risk per trade. Now again, it could be percent, it could be multiple tiers based on it's a good trade, great trade, excellent trade, and each one gets a different level of risk management. Maybe it's off clarity. All these kinds of things you need to ask yourself. But before you really finalize your rules, ask yourself, what is your risk management strategy? Is it going to be based off a dollar amount per trade, a percent amount of trade, which I always prefer that one? Is it off the clarity of the trade? Is it a tiered system of like a good trade gets $200, a great trade gets $400, and an excellent trade gets $800? And you just risk 3% every single time. All these are great options, right? It could be even individual based on the ticker. But before you finalize your rules and then move on from this course, think about it to yourself. What is my risk management strategy? Trailing stop loss, hard stop loss, alerts, whatever it's going to be. Then how do you calculate it, right? Is it tiered? Is it just a number? Is it a percent? Think about that before you finalize this class and this course. What is your risk management strategy? And of course, how do you find that out? That's first. Second thing to think about during this class and as we wrap up is, why do you prefer technical analysis setups? I myself really enjoy bullish setups. I do like horizontal and wedge downs as well as time has gone on, but nothing beats a good old-fashioned horizontal channel or channel up. That's just what I like. If you throw a 200 EMA bounce in there, boy golly, I'm excited. Compared to maybe like a wedge down or like a falling broadening wedge, or some folks really like downward triangle breakouts, and some folks like the 5-minute 10 crossovers. It's all down to preference, right? I do know what my bread and butter is. What's yours? So as time goes on, as you get a better trader, what 4 or 5 setups do you really like? And of course, it could be any pattern, any indicator setup, RSI under 30, whatever it is. Think about and focus that as you kind of get on by yourself. And I'm going to be here to hold your hand the whole time. So man, figure what you like. It's just like LeBron James and all these athletes we talk about. Are quarterbacks good at kicking? No. Are pitchers good at hitting? Sometimes, but often no, right? The reason is a lot of athletes specify and get good at a few things over okay at a lot of things. If you're really good, like you win 85% of channel up plays, why are you playing anything else? If you're batting half on wedges that are sideways compared to channel ups, why are you playing wedges when channel ups are there for you, right? Find out what you're good at, stick to what you're good at, get really good at it, and then move on. So consider and talk about amongst yourself, what technical analysis patterns you like the most and what setups do you like the most. Third, or what candlestick patterns do you enjoy the most? That kind of goes to the second one, but we didn't talk about that in this course. I think it's really not the greatest thing to talk about. The reason is time frame analysis becomes super convoluted for some people, especially for beginners who are like, I like bullish engulfing, and then they go find the bullish engulfing and a crap technical setup, and it doesn't work out because the candlestick pattern is like 1/8 of what I would look at technically in the first place. It's not a lot, but I think considering like three green soldiers, bullish engulfing, dojis, hammers, whatever it is, go do some extra independent research and find out what kind of ignition candles and switches do you like for entering a trade. I didn't discuss it here in this course. I will eventually. There's a bunch of resources, but as you kind of finish up this course and go by yourself, ask yourself, again, secondly, what are my favorite technical analysis patterns and setups? And then third, what kind of candlestick patterns do I like as well? Because a lot of time frames have some real juicy entries, and the candlestick patterns is probably your best friend. We didn't discuss that here. I'll discuss it later in a different course, but for now, go do it by yourself. Research that. It'll help you immensely. Trust me. Fourthly, as you finalize your rules, what parts of fundamental analysis do I favor? What do I not care about? This is huge, especially when it comes to our macro markets. I can't name a single stock picker, whether it's Warren Buffett, Peter Lynch, whoever it is, ever care to talk about macroeconomics. They don't care. They never have care. They're never going to care. That's a well-known fact. When it comes to the Russia-Ukraine incident, when it comes to COVID, when it comes to all these types of things, winners can find and pick winners. It doesn't matter what the markets are doing. It's never mattered, right? All that means is when you start throwing in more variables, the more confused you're going to get. I like PE ratio. I like EPS. I like debt ratios, and then ROI, A&E. It's all I look at. If I have that, plus I can read a little bit about the company, I'm happy. The more variables that you know does not mean the better trader you're going to be. If you can have every variable in the world, it doesn't matter. If it's a bad pick, it's a bad pick, right? If you're good at technical analysis, stick to that. If you're good at fundamental analysis, stick to that. But throwing more variables into it, more macroeconomic stuff, more of this news-driven stuff, it never works, right? It's not what's supposed to happen. A good stock pick is a good stock pick. So as you finalize this course as well, think about, reflect on what kind of fundamental analysis do you like, what do you rely on, and again, as I said in the beginning of this course, stock trading is 80% technicals. Stock investing is 80% fundamentals. Those switch from short-term to shorter term to long-term to year-long holds. So I don't really do the long-term outside of really well-known stocks and blue chips, so it doesn't matter much to me anyways. But that's what I want to think about is, again, what fundamental aspects do I focus on and what fundamental aspects do I enjoy the most when it comes to trading. Finalize that before you kind of move off this class. Fifth is, what is your definition of fear and accountability? What really makes you upset? What really makes you fearful in the market? Identify that before you leave this class. It may be unknown variables. It could be large risk margins. It could be missing out on FOMO. Identify what your fear is. Whatever it is the most, at least know what you're dealing with. I don't have FOMO. I've never had FOMO. A stock can run 100%. I don't care. It doesn't bother me in the least, right? I actually have more of a joy of missing out on a lot of things when I watch them all start crashing down, honestly. I have a fear of high risk. That's why I trade the way that I trade, with such clarity and low risk entries is what I like. But when it comes to your fear, identify and think about what makes me really scared in the market. So that way when you start forming and changing, because this is going to change, your entries, exits, your plans are going to change as time goes on. At least you know what fear drives you and what you can focus on. Also with that, what is accountability? What to you is accountability? You know, is it accepting the outcome of a trade? Is it walking away and learning how to walk away and take days off? Is it knowing, when are you allowed to hit the button of buy and sell and having rules set in place? Understand yourself, think about yourself, and how you hold yourself accountable and hold yourself away from, but also understanding fear. If you have fear-based decisions, that's the worst thing you could have. And if you have no accountability, it's probably the second worst thing you can have. Think about those two words, how they affect your trading strategy and structure, and then go from there. 6 is, what macro markets do you focus? I think popularly it's going to be the 4 that I use, the S&P, the NASDAQ, the Russell 2000, and the Dow 30. Now there's other great ones and how you can use them. There's a bunch of great other indexes as well, or ETFs you can track, and hedge funds or whatever. How do you use them is major. I myself use them as gravitational forces, right? As I've talked about before, it's not a secret that I think that the S&P is a gravitational force. When it's green, most of the stocks are going to be green, and when it's red, most stocks are going to be red, and then the NASDAQ to a lesser effect, the Russell to a lesser effect, and then the Dow specifically for blue chips, but again, to a lesser effect. With that being said though, there's plenty of other macro markets you can use. You can use foreign markets, you can use the Forex market, you can use a whole lot of different things that really help influence your ideas and what you want to trade and where you want to trade your money at. If you love small caps, maybe the Russell's higher and less than the Dow 30. That makes sense. You like to just trade industrial large caps. The Dow 30 will be higher than the Russell 2000. That's okay as well. The one thing you shouldn't do is find a index that you like or a hedge fund manager that you like and practice their trades by just doing the same exact thing. If you're copying someone else's trades, who's a hedge fund manager, a YouTuber, anyone, you're going to have a bad time. I kept saying in 2019 as Kathy was just running up, I was like, this isn't going to last, big fella. This is not good. And then folks I caught buying at the top, and now it's towards 80% down. It is what it is, right? Stop tracking hedge fund managers. They're just as lucky as the rest of us. It is what it is. You have to make your own decisions. Don't rely on other people. It's smart. So again, what do macro markets do? Hedge fund managers that you like, all these types of things. What do they mean to you? How you track them? How you focus them? Think about that before you leave this class. 7's how do you write your trading plans? I myself actually just make mine public. It's when I do